We are getting closer to Christmas, and financial markets will be looking to no fewer than 4 central bank meetings in the coming week. Whether they've been naughty or nice, investors will want to see just how generous those central banks want to be when it comes to providing support to the economy and providing the bountiful, cheap liquidity which, some commentators argue, is helping asset prices from shares to bonds to gold to Bitcoin to horseflesh to keep on rising. In order, we have the US Federal Reserve on Wednesday the 16th of December, the Bank of England and the Swiss National Bank on the 17th, and the Bank of Japan on the 18th. I'm sure most of you will be most interested in the Bank of England. At the last meeting in November, the Monetary Policy Committee, or MPC, voted in a clean sweep, 9-0, to keep interest rates unchanged at 0.1%, but to increase quantitative easing, or QE, by £150 billion to take the total to £895 billion. The old lady of Threadneedle Street seems to be backing away from the prospect of negative interest rates, in effect charging savers to keep their money in the bank, although the MPC still seems split on the possible economic benefits of the proposed vaccines for COVID-19. Governor Andrew Bailey, for example, seems more optimistic than fellow committee member Michael Saunders. In addition, there is still Brexit to contemplate, as the transition period ends on 1 January, to confirm the UK's departure from the European Union, and also, let's face it, inflation continues to run below the Bank of England's 2% target. So, the committee have got much to consider, and the other central banks face similar issues, at least in terms of how their economies are being affected by the pandemic, and how they continue to miss their own inflation targets too. Not one of the Fed, Swiss National Bank or Bank of Japan seem in any hurry at all to raise interest rates. In addition, all three continue to run quantitative easing schemes, with even the Fed's balance sheet starting to expand again. In dollar terms, the 5 big central banks, Bank of England, Bank of Japan, ECB, Swiss National Bank and Fed, have increased their balance sheets by $7.8 trillion in 2020 alone. It took the same quintet from October 2008 to March 2017 to add that amount in the wake of the financial crisis, or 8.5 years to do what they've done in 11 months. And in percentage terms, that's a 50% increase. Now, some argue this is necessary to help governments fund the huge increase in debt that's resulted from support schemes provided to combat the pandemic and the recession. Some others will argue such money creation will only back up the assertion from French writer and philosopher Voltaire that fiat currency always returns to its intrinsic value. 0. And they'll also then add that this may be why gold, Bitcoin and other perceived currencies or stores of value have done well in 2020. You'll have your own preferred view on which you think is correct, and I shall leave that to you. And in this case, quite literally, you'll be paying your money and making your choice. Now, corporate news flow will be relatively quiet this week, not least as no FTSE 100 firms are scheduled to provide any results or trading updates, although a handful of mid and small caps are scheduled to update shareholders. Names which may be worthy of note include the following, although some of these dates are still subject to change. Hollywood Bowl on Monday the 14th of December, Chemring and SSP on the 15th, Dixon's Carphone and Petrofac on the 16th, and Watches of Switzerland on Thursday the 17th of December. But the company which just could cause the biggest fuss in the week ahead is Shaftesbury. The Real Estate Investment Trust, or REIT, is due to release its full year results on Tuesday the 15th of December. Now, Shaftesbury is a commercial property landlord, and just 1 short year ago, you'd have probably said that it owned an enviable array of assets in London, including chunks of Chinatown, Soho, Fitzrovia and Covent Garden. However, shares in the FTSE 250 company are down 40% over the past year, much worse than the 8% drop in the FTSE All-Share over the same period, thanks to the pandemic and concerns that even once the virus has been fended off, office workers, consumers and tourists might not quite come back in the same numbers. Those fears reflected in how Shaftesbury's shares trade, as I record this, at a 35% discount to their last stated net asset value, or NAV per share figure, of 878 pence. Now, that's investors' way of saying that they think the value of Shaftesbury's buildings and assets is going to fall in the future, and indeed that rents might do the same. So, the first number that analysts will look to is NAV, and it was 982p a share a year ago, and had fallen to 878 pence per share figure by March. Now, the next key number is rental income, which reached a record £117 million in fiscal 2019. In the first half, rents received dropped by just 3% year on year, but that was the 6 months to March before the pandemic and lockdowns had really hit. September's trading update revealed for the second half that 41% of rents due for the 6 months to the 30th of September had been collected, 10% were subject to deferred collection arrangements, 23% were being waived, and 26% were still outstanding. Analysts will then look to the vacancy rate, which rose from 3.2 to 4.8% in the first half and had then, according to the September trading update, jumped to 9.7% by the end of August. Attention will then switch to the balance sheet. At the first half stage, Shaftesbury's net debt position of £937 million for a loan-to-value ratio of 27% was actually pretty modest for the sector. But the company has since raised just under £300 million from shareholders in a deal priced at 400p a share in October. Key investors Norges and fellow London-listed REIT Capital and Counties both participated. The final point of interest will be the dividend. Shaftesbury cut its interim dividend from 8.7p a share to 0, although some analysts suggest a small final payment may be made. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you all for listening, and I look forward to talking to you again next week.